Okay. So residual income we are supposed to start now. But before that, have you tried all other module quiz? You have questions on anything? You want me to repeat anything?
No, I have tried it. I've not done all the module quizzes, but
Mm-hmm.
I've tried it. I've done a few questions,
Mm.
and they're pretty easy. And if I did not get it, I saw the answer and I understood where I was wrong.
Okay, fine.
So if I don't get it, then I'll come to you. Like a few
Mm-hmm.
questions are left.
Okay
Many
then.
questions are left. Actually, I did not see. I I did around 5 questions, and
Mm-hmm.
then I saw it right now that there are 15 more questions. So I did not see those. I thought there are only
Okay.
5 questions.
Okay, fine. See now
Yeah.
residual income valuation. When should we use residual income? Okay.
Okay.
Residual income. Say for example, residual income or economic profit. Okay. So when should you use? Say for example, a company is not paying dividend.
Okay.
If your company is not paying dividend, then how can you use a dividend discount model? Will not work.
We can use cash flow model.
But the company does not have any free cash flow also. So
Okay.
free cash flow to equity. But the problem is there is no free cash left out
Okay.
in the firm. How is it possible? Your free cash, how is it not left out? Because it is making profit, however,
But
but
they
there
are
is no free
spending
cash
it.
flow. They are spending capital expenditure for
Yeah.
further expansion of the business.
Yeah.
Now there is no free cash left out only. Then how will I do? So in that case, I'll go for residual income. That means company is making profit.
Hmm.
Okay, but nothing is, no cash is free with the firm.
Hmm.
So in that case, I can go for residual income.
Uh,
Okay.
but sir, I have a doubt here. How
Hmm.
can a cash flow be negative?
It is not negative as such. There is nothing left out with them. That means the
Okay.
money has been invested.
Huh. But I've
Okay.
seen cash flow statements where the statements end in negative figures, like
That
negative
time
500.
they might borrow also. Then that is
Okay.
possible that they will borrow as well. Okay. So because they
Okay.
are expanding, right? So see,
Yeah.
quite possible that you have made profit in your business,
Yeah.
but then you want to expand heavily, and also you are ready to borrow because there is a tailwind in your business.
Okay.
So that is also possible. If a company is aggressively moving ahead,
Hmm.
aggressively growing, then they can do.
Okay.
Okay. So now residual income, see the example, one simple example first I'll give you. We'll do this sum first, okay? That will serve as the example, and then we will come back to the theory. It will be easier to understand.
Okay.
Okay, see this now. Just go through this question.
Yeah. Okay. I read the.
Yeah. Okay. So Madira Fruit Suppliers MFS distributes fruits to grocery stores in large US cities. The book value of its assets is 1.4 billion book value, which is financed with 800 million in equities and 600 million in debt. Its before tax cost of debt is 3.33 percentage,
Hmm.
and its marginal tax rate is 34 percentage. MFS has a cost of equity of 12.3 percentage.
Hmm.
Okay, and then MFS's abbreviated income statement is shown in the figure. Okay,
Yeah.
so EBIT, then less interest expense, then pre-tax income, then less interest income tax, then net income.
Hmm.
So net income is 8520.
Okay.
Okay, so net income is equal to 8520.
Hmm.
So now what I will do, that means here cost of debt has been deducted in the form of interest,
Yeah.
but then cost of equity has not been deducted.
Huh.
So what is the cost of equity? So equity, that is technically called as equity charge.
12.3%.
Equity charge is equal to, yeah, equity capital. Equity charge is equal to equity capital
Hmm.
into cost of equity.
Okay. So
Okay, it is
that much
given here.
amount they have to pay in cash,
Equity
basically.
capital into cost of equity, not in cash. This much you are going to keep it aside because you are not practically pay anything to the equity
Ha
holders.
ha ha ha.
This is what they deserve. Okay,
Ha.
ideally they deserve this much. Everything belongs to them
Okay.
only, but this is what was their required rate of return.
Hmm.
So I'm just calculating what is the required rate of return and how much amount it comes to. See, the required cost of equity is 12.3%. So equity is 800 million. So
Yeah.
out of 800 million
Out 800
into
million into 12.3%.
12.3 percentage, you calculate
98.4.
98.4 point 4, as in, just tell me the complete number.
Uh,
98 million, is it?
98 million
400.
400,000.
Okay, so this is what they are supposed to ideally give it to the equity holder. So we
Hmm.
will assume as if like they have paid. So in that case, 98 400, is it 98 400 here?
98
Then
million 400,000.
98 400, correct only. So if I think that they are supposed to pay 98 million 400, that means, you see, in this case residual income is actually negative. There is no residual income
Oh,
in this case.
how is it negative?
Yeah, it is possible now, because they are
Ha ha
they are
ha.
supposed to, because company made profit.
Ha.
Accounting wise it is a profit, but then
Hmm.
they have not made enough profit to be,
Hmm.
as per whatever equity holders deserved. Okay,
Hmm.
so residual income is negative over here. There is no economic profit over here. See this one,
Okay.
even though MFS is profitable in the traditional accounting sense, it is economically unprofitable after taking into account the necessary charge to meet shareholders' opportunity cost of capital to the
Hmm.
company. Okay, so in this case, even residual income will not work. Residual income is actually negative. But this is to tell you like what is residual income. So quite
So,
possible that a company which is making positive profit, its
hmm.
residual income might be negative. In this case, 17,880.
Hmm.
It is negative. Okay, residual income. That means this much they are supposed to create more actually. So it is not enough
Hmm.
profit.
So,
Basically, it is taking into account, the opportunity cost as well. Huh.
so this is something that this income is something that they should have uh, to compensate their equity holders,
Yes,
basically.
yes, they should have created more profit. So equity holders, will they be happy with this profit? No.
No.
Company made profit, but will the equity holders be happy? No. It's like you deserved 1,000 rupees profit in your company and you made 600 rupees profit. Are you
Hmm.
happy? You made profit, but then you are not happy. Why? Because you are thinking that you made so less profit.
Hmm. Okay.
Okay.
Hmm.
And beyond this, rest all are residual income. Like if this would have, suppose for example, instead of 8520 here, I mean instead of 98, imagine the residual income was 50,520. Then in that case, I mean the cost of equity charge was 50,
Hmm.
520. Then this would have been your residual income.
Hmm.
Okay,
Hmm. Got it.
now you just read this
Yeah.
theory. So residual income is the economic profit. So this, in this case, this is the residual income. This is the economic profit.
Hmm.
It's 30 million. Here there is no, in this case, whereas in this actual sum there is no economic profit. Now you go through this. Is it okay?
Yeah, it's
So residual income deducts explicitly all capital costs. That means
mm,
equity as well as cost of debt.
mm,
Okay. Now EVA, economic value added, measures the value added for shareholders. So this is another way.
okay,
This is another way. So conceptually, EVA is also measuring economic income only.
okay,
Okay. Now in this case, economic value added.
okay. I had this in college, EVA and MVA.
Okay.
Mm.
Economic value added is equal to NOPAT. What is NOPAT? I'll let you know now.
Net profit
Minus,
after tax, na?
no. Net operating profit after tax.
Okay, huh.
Okay. WACC into total capital. What does that mean? Okay. So NOPAT is equal to EBIT into 1 minus tax.
Okay.
Okay. Minus, so I'll put bracket here. Minus WACC into total capital.
Mm.
Okay.
Mm.
So what does this mean? I'm not sure if you have understood this part. Let me write it vertically. See, we write like
So,
this, right? Sales
huh.
minus cost of goods sold, then
Uh,
gross
Gross
profit
profit,
minus sales general and administration, then EBITDA,
EBITDA minus depreciation, EBIT.
yeah, minus depreciation, EBIT minus interest,
Mm.
minus earning before tax,
Mm.
minus tax, earning after tax.
Mm.
Now, from EBIT, without deducting interest, I'm
Mm.
directly deducting tax.
Or else we
Okay.
can add back the interest, basically, after EAT.
Yeah. But then I'm supposed to deduct interest, yeah.
Hmm.
So EBIT into 1 minus tax, this part is called as NOPAT.
Hmm.
This is NOPAT.
Hmm.
Net operating profit after tax. It is
Hmm.
operating profit after tax, but without taking into consideration interest. Okay,
Hmm.
this is NOPAT. So because I did not take into consideration debt here,
Hmm.
so that means even equity, anyways, cost of equity I have not deducted. So both cost of equity as well as cost of debt I have not deducted. So
Hmm.
now I'm taking both the costs together, which is called as what? WACC.
Back.
WACC for the total capital, and then I'm
Hmm.
deducting.
Hmm.
Okay, so EBIT into 1 minus tax, then minus WACC into total capital.
Hmm. Got it.
Okay, so this is this WACC into total capital also. It is written as EBIT into 1 minus tax minus, it is written as dollar WACC. Dollar WACC. Okay,
Hmm.
dollar represents amount.
$1
Dollar.
costs.
No, this just the dollar WACC means it represents amount.
Okay.
Total amount, WACC amount.
In dollar.
Yeah, in dollar. Okay.
Okay, WAC is in percentage and WAC is in amount, like that.
Now I'll do the sum. You will get it. Okay. So
Okay.
you may just read this part.
Yeah.
See the difference in calculating between residual income and residual EVA. Residual income is net income from net income minus charge of
Hmm.
equity.
Hmm.
EVA is NOPAT, and from NOPAT we are reducing the cost of debt and equity.
Hmm.
Conceptually, they both are, measuring economic income only.
Hmm.
So for the purpose of EVA computation, we use beginning of year total capital. Yeah,
Okay.
beginning of the year, because from that capital only you are doing the business. Then
Okay.
market value added. Uh, Discuss later. Uses end of the year. Okay, these are some adjustments that one should make. Okay. for before calculating NOPAT. Capitalize and amortize research and development charges. Yeah, these are all
Hmm.
some other adjustments. Okay, this is little memory based one. This part. See, capitalize and amortize research and development. So, if you are calculating this method NOPAT way,
Hmm.
then these are the adjustments that you are supposed to do. Capitalize and amortize research and development rather than expense them. Because normally, what would have happened is you would have expensed it.
Hmm.
So, you are supposed to capitalize it and add them back to earnings to calculate NOPAT. Okay. So when you capitalize it, your profits will go up, no? Because instead of income statement, you are pushing them to
But
balance
sir,
sheet.
development charges can also be expensed and also be capitalized, no?
Correct. But then now you are not following the proper standard, right? Now you are going as per what NOPAT is asking you to do.
Hmm.
So if you are following through NOPAT method, then these are the changes that you are supposed to do.
Okay.
Okay. Then add back charges on strategic investments that will
Hmm.
generate returns in the future. Because all these you would have expensed actually.
Hmm.
Okay. Because basically the intention is it is purely operating profit only they want. So all these are not pure operating profit, right, like research and development. So they want to capitalize this one.
Hmm.
See this one, strategic investments, deferred tax assets. So all these they don't consider that as proper or pure operating stuff.
Hmm.
See this, treat operating leases as capital lease and
Operating
adjust
lease can be
non-occurring
an operating expense, no?
non-occurring items. Treat operating leases as capital lease only. So
So,
purely only operating, whichever is in a dilemma, dicey thing, push all those to capital,
so if you
all
have
those to balance sheet.
leased a plant, leased a factory, and through that factory only you're doing business, so the lease expense of that factory is an operating expense. Now, how can we capitalize it?
Uh, if you remember in level one, we did, leases can go under financing as well as under operating. In IFRS, the treatment is the same.
Huh.
Okay, you remember those are all again rules based one. How you are treating your leases, because
Okay.
there can be a lot of manipulations in the name of leases.
Hmm.
Okay, manipulation in the sense, they will they may not want to show that asset in their balance sheet. All those things are possible. So
Yeah,
that's
because
why,
that is
huh,
my point is only that if that lease, the expense of that lease is your core operating expense.
huh,
So why will I capitalize that? I will expense. No, I will
huh.
expense it.
Yeah, so that is the accounting stuff that you are showing. But
Huh.
as per NOPAT, it says like whatever you can capitalize it, capitalize it.
Okay.
This is changing as per NOPAT's calculation. See,
Hmm.
company to company, when as an analyst, when you are calculating practically, you can change all these stuffs.
Hmm.
But then here, when we are learning, there has to be some standardization, right?
Okay.
And that standardization for NOPAT, it says, because otherwise, what will happen? Otherwise, for your NOPAT will differ from others'
Hmm.
NOPAT then.
Hmm. Hmm.
So if you want one standard answer, then what is that? So because many people try to uh, operationalize that leases to reduce their profit.
Hmm.
So the standardization is that no, you capitalize it.
Hmm. Okay.
Okay. Why do they want to
Okay.
reduce their profit? Again, obviously to save
To
taxes.
save taxes.
Okay. Then add LIFO reserve to invested capital and add back in LIFO reserve to NOPAT. So these all are the changes. This is memory based one.
Hmm.
Okay. Add LIFO reserve. LIFO reserve means what? When you convert from LIFO to FIFO.
Hmm.
Okay, so imagine if you are using LIFO and you want to convert from LIFO to FIFO. So that
Hmm.
time you will have LIFO reserve. So that should be also added to invested capital and add back changes in LIFO reserve to NOPAT.
Hmm.
Okay. So yeah, these are all the changes. Basically, you can think like they want pure NOPAT and they are trying to, and it is more biased towards increasing the profit.
Increasing the profit. Yeah.
Okay.
Hmm.
Then market value added. So market value is equal to market value of the company minus total capital. That
Okay.
means if the total capital is 10,000 rupees and if the market value is 15,000, that means market value added is 5,000.
Hmm.
This is
Market value
straightforward.
means market capitalization, no?
Yes, yes. Okay,
Okay.
you can read this. This, see, the way they are writing, articulating, those all are important. Okay.
Hmm. Yeah, this is got this. But EVA, MVA, both of them they are saying same, no?
Yes. Uh,
Like in economic value
no,
added
no, no.
measures.
See, um, economic value is more like, calculative one. Market value is, calculated by the market, right? Economic value added is more analytical one.
Okay.
With certain formula, you are calculating economic value added. Market value added means based on whatever the market, like let's say there is bull run going on in the market. That time
Hmm.
market value added will be very high,
Hmm.
or else the market is very bearish. Then the market value added will be very less.
Hmm.
But economic value added is more based on the fundamentals. Okay, you'll see
Okay.
this in this example. See this here, because market value is what done by the people, right? Investors are
Hmm.
valuing it. Economic value is based on all the calculations. See this here, VBM Inc. reports NOPAT of 2100 and WACC of 14.2 percentage.
Okay.
And invested capital is 18,000 at the beginning of the year and 21,000 at the end of the year. The, the market price of the firm stock is $25 per share.
Hmm.
Okay, this is market price. And VBM has 800 shares. So multiplying this will get me
We'll
the
get the
market value.
market value. Yeah.
The market value of the long term, this is long term debt, is 400,000. So calculate EVA and MVA.
Hmm.
Okay, so EVA, economic value added. So we have, let's follow this one now. Economic value added is what? NOPAT minus WACC into total capital. See, this is what this is as per the formula. NOPAT is what? Coming from the fundamental statements. All these are coming from the statements.
Hmm.
Okay. So EVA is equal to NOPAT into 1 minus 1 minus tax. Okay. Minus dollar WACC.
They've not given tax, but yeah, tax rate. NOPAT is EBIT into 1 minus tax, na? They have directly given NOPAT.
Okay, directly, where is it given directly? Okay, so fine. NOPAT into, acha, sorry, this
NOPAT will be
formula is wrong.
EBIT into 1 minus
Yeah,
tax.
this formula is wrong. NOPAT minus WACC into total capital, economic value added. So this NOPAT can be written as EBIT into 1 minus tax minus dollar WACC. Now this entire thing they have already given 2,100 minus dollar WACC. So dollar WACC is invested 18,000 and 20,000. Invested 18,000, okay, at the beginning and 21,000 at the end of the year. So end of the year does not matter. Beginning is based on the opening capital we are supposed to calculate. 18,000. 18,000 EVA and where is WACC here? WACC is mentioned. Okay, directly all these are given. 14.2 percentage. 14.2 percentage of invested capital. So capital means
18,000.
both equity as well as bond total 18,000. Just calculate this.
It's minus 456. No, okay, not this, not this. The total answer is minus 456.
How much is
This
this?
answer is 2005 56.
Hmm. 4?
456 negative.
EVA. So economic value added is negative. So again, no economic value added here.
Hmm.
The next one is market value added. Market value added is equal to market value of the company minus total capital. So market value is number of shares into price per share minus total capital. Number of shares into price per share. Number of shares, price
It's
per
20,
share 25.
25 into 800.
Number of shares is
800.
800 shares
Yeah.
outstanding. Minus total capital is 4,000.
Is the market value of firm's long-term debt.
Market value added is equal to market value minus total capital. So market value is this much, total capital. They have added it. Market value of the company is the market value of equity plus market value of debt. Okay. Okay, market value of the company is the market value of equity plus debt also. Market value of debt, yeah. So that means market value, I should write this formula as um, market capitalization plus market value of debt minus total capital. So market capitalization is 800 shares into 25 plus market value of debt
Plus
is
4,000.
4,000 minus total capital. Okay.
Hmm.
So total capital is beginning 18,000 and at the end of the year it was 21,000. So because end of the year, currently it is 21,000. I will take 21,000
Hmm.
because this is, I can say, total capital, current total capital. Okay, right now, what is the total capital? Just calculate all this now.
Uh, the market value is 24,000. 20,000 plus 4,000 is 24,000. Minus 21,000.
So market value added is 3,000. So company's economic value added is negative,
Yeah.
whereas market value added, so the market is more bullish about the company. Okay, but right now economic value is not showing much.
So their accounting wise, they are not
They are not
doing
good.
well.
Yeah,
Okay. But the market sentiments are bullish.
yeah, yeah.
Hmm.
So you remember market value of the company includes market capitalization as well as market value of debt.
Hmm.
Yeah, you can go through this. Why residual income models are there?
Okay. Done, sir.
Yeah. Okay. This kind of theories all can come. Okay. Now residual income computation. Now two formulas are given over here. Okay.
Hmm.
So again, residual income has many formulas. Okay. So what we have seen initially was uh, where have I added residual income? Hmm. So residual income is equal to net income minus equity charge. This is one formula.
Hmm.
Then some other formulas. Yeah. Earnings at time t minus r into bt minus 1, that is equal to return on equity minus r. Bt minus 1. So what does this mean? See, earnings at time t right now.
Hmm.
This is opening book value. So with this capital, you are starting your business for the year, and
Hmm.
this is the required rate of return. So this much you require. Say for example, you earned 100 rupees. You started with let's say uh, 200 rupees. When you started with 200, your required return was, let's say, 10 percentage. So that means 100 minus 20. So your residual income is 80 rupees.
Okay.
Okay, you expected to earn how much? 20 rupees.
Hmm.
Okay, but you earned 100. So extra residual income is 80.
Hmm.
You can also think in this way, return on equity. So you have earned how much? Actually, you have earned 100. That means out of 200, you have earned 100. So I
Hmm.
can say your return on equity is 50 percentage, because out of 200, you have earned 100. And required return was 10 percentage only.
Hmm.
So that means 40 percentage you have earned more and based on the opening capital was 200. So this also comes to 80. Just check 40 percentage. Yeah, it will
Yeah.
come to 80. So both the ways you can calculate. Okay. So you have to remember
Hmm.
both. Okay. Reason being, sometimes they might give you um, yeah, sometimes they might give you return on equity, sometimes they might give you total earnings. So
Hmm.
accordingly, you have to decide which formula to be used.
Hmm.
Is it okay?
Yeah.
Okay. So this formula only you have to remember, okay? Uh, because people normally, if you are very sure like which formula to be used, most
Hmm.
of the questions in equities will not be a problem then. Okay, which formula to be used, that you should be clear. Otherwise, everything information will be there in front of you, but you will not know which formula to be used now. Okay.
But there are every formula have two or three variants, na, in equity.
Every
Like
formula has
like there is justified P ratio, there is trailing P ratio,
ah
like that.
hmm, ah
So
ah
like
yeah,
this in
yeah.
this also
In
there
this also there are
this
variances. Correct,
yeah.
correct. Yeah.
So I just need to know the basics, and then most of the formulas have gotten
You should
growth.
be comfortable. Yeah, you should be comfortable with this, with all the variances.
Hmm.
Okay.
Yeah.
Then next one. Okay, let's do this sum now. Just go through this sum now.
Sir, in this sum, they are asking to compute the residual income over for the next 2 years.
Huh.
They have not given us growth.
Okay, see this one company, this CEO was assigned the task of forecasting the residual income for Delila Cosmetics over the next 2 years. Okay, next 2 years. To accomplish this task, Kraft assembled the information provided in the following figure. Okay, Kraft used a required rate of return 11 percentage. Okay, so residual income for 2025 and 26. Required rate of return is given.
Hmm.
Then current book value is given. So that means this part book value is also given. Current book value, okay, 2024. That means this is the opening one for 2025, which is what I want. Opening book value, right? For 2025. Then consensus annual earning per share. So earning. So I'll come this side now, left hand side, this formula.
Okay.
Okay, so for this formula, now, okay, dividend payout ratio is given. So dividend payout ratio is also there. Okay, fine. See, I'm going to write it in a certain format. So you just follow that format. It will be easier. Okay.
Hmm.
So yeah. So this is that format here. See, first is earnings.
Okay.
Um, Not earnings. Sorry. First is opening book value. Okay. Opening book value. So this is for 2025 and then 2026. So what is the opening book value? See, for 2025 it will be 18.
Yeah. Hmm.
Then plus there will be earnings for that year.
Hmm.
Earning is how much? 31st December 2025, 2.05.
But that is the closing earnings.
Yeah, so end of the year only you will get the earnings. Na?
Yeah. So,
Okay. So earnings you got. Then from that earning, you are going to pay dividends. Dividend is
65% of
65. Take 65
2.05.
percentage of 2.05.
1.3325.
1.3325. That you will deduct.
Hmm.
So this will be your closing book value then.
Yeah, okay.
Calculate 18 plus
Okay.
2.05 minus 1.3325.
18.7175.
18.7175.
75.
Now this will become your next year's opening book value.
Hmm. Hmm.
Okay, but you hold on. There is something more to be done. 18.7175 book value. Okay, now we are calculating residual income, right?
Hmm.
So from this closing book value, we have to reduce equity charge also. Okay,
Okay.
equity charge.
But then we don't have the total equity.
Equity charges. Equity charges.
Okay, 24
11
is our,
percentage is the required rate of return,
and current market price is
and
24.
so equity charge will be, see, we started with 18, so
Yeah,
18 into 11 percentage, calculate this.
1.98.
1.98 is the equity charge. So residual income then would be earnings. We know earning means net income minus equity charge will give me
Hmm.
residual
Residual
income.
income. Yes. So it will be 0.07.
So two things I have calculated here. One is, what I need is uh, book value, closing book value, which
Hmm.
becomes my next year's opening book value. And
Hmm.
also in this format, I'm calculating the residual income.
Okay,
Okay,
yeah.
let me just check
Okay.
the answer. 0.07. Yeah, right. Till here it is fine. First year's
Yeah,
residual
yeah.
income. Now,
Uh,
same way, now second year I'm going to follow. Earning is, what is the earning? Earning consensus is
2.22.
2.22. So 2.22. And dividend, from that I'm going to pay dividend as well. No? So dividend, what is paid out? Dividend is 65 percentage. So take 65 percentage of 2.22.
1.44.
1.44. Now calculate all this.
19.497.
Okay, then equity
11%
charges
into
11 percentage of
18.7.
18.7175. Yeah,
2.05.
2.05.
Hmm.
So I will reduce that from my earnings.
Hmm. 0.17.
0.1617. It's okay. That is fine.
Hmm.
This format you have to adhere to. Okay, if you remember this
Yeah.
format, it will be easy.
I'll just write this down, sir.
Yeah. Once done, you let me know. Okay.
Yes, sir.
So basically, we have followed this formula only. Okay, here, this
Yeah,
first part of the formula.
yeah.
Earnings, from earnings, we are calculating equity charge.
Yeah. This is easy. It's not like
Yeah,
that difficult.
yeah. No, this entire subject is easy only. Yeah. Okay, now, next one.
Derivatives was
Uh,
much more difficult than this.
derivative is more highly practice oriented one.
Yeah.
Yeah, more thinking is needed. Okay.
So all the subjects are like this, or it's like derivatives.
No, it is all mixed one. No?
FSA and fixed income might be more difficult than this, no?
FSA is difficult. Fixed income is difficult. Yeah. Okay. Corporate issuer is a very easy self-reading subject only. Okay.
And economics is also easy.
Economics, only two readings. First reading is like derivatives.
Oh,
Second reading is very theoretical kind of thing. Theoretical means little impractical theories all will be there. First one is all currencies.
okay.
It is an extension of derivatives. Okay. The next one, computing intrinsic value. Now we have calculated residual value. Now see
Okay.
residual. Now if I want to calculate intrinsic value of the stock, how will I do is divided by 1 plus. Okay, 1 plus. Um, okay, 1 plus. What is the cost of equity here, or discount rate? 11 percentage. So if whatever be the discount, this is the cost of equity. Now whatever be the discount rate, at that discount rate I'm going to calculate. Let's say here if I use the same 11 percentage as the discount rate,
0.07.
this will become, adding
Zero
these two
point
will give
zero
me value.
six three.
And
First one, yeah.
second one,
Yeah. 0.1379. 0.2 is the answer.
yeah, but in this case, okay, right now this is fine. Okay, we will also see. Okay, right now this is okay. Now see the next sum now. Consolidated pipe products has a required rate of return of 14%. Current book value, that means B0 starting 6.5. Earning for 2025, 26, 27 are Canadian dollar 1.101 and 0.95. Okay, it is decreasing. And dividends in 2025 and 26 are forecasted to be 0.50, zero point 0.6 respectively. The dividend in 2027 is a liquidating dividend, which means that consolidated will pay out its entire book value in dividends and cease doing business at the end of 2027. Calculate the value of consolidated stock using the residual income model. Okay, the dividend is a liquidating dividend. Okay, so what we have understood here is they are asking for residual income and they have given earnings. So I will write the same format again here. So first is opening book value.
Sir, can I try this sum?
You try for 2025 and 26. 27, there is a change, liquidating dividend. So you try for 25 and 26. For 27, I'll do it. So you're doing now, right?
Yeah, yeah.
Okay.
Done, sir. Hello. Hello.
Hello.
Hello.
Yeah.
Yeah.
You have done.
Yeah. Yeah.
Okay. So opening book value, then earnings, then dividends. So this is the format. You remember the format. Then you will get closing book value. Okay. Then minus equity charge. Then you will get residual income. Residual income. So opening book value is current book value is 6.50. Then earning 2025. So this is 2025, 2026, 2027. So earning is 1.10, 1.10, then 1, and then 0.90,
Nine
95.
five.
Dividends in 2025 and 26 are forecasted to be 0.50. So 0.50 dividend and 0.60. Okay. The dividend in 2027 is a liquidating dividend. So this is a liquidating dividend. So we will see what is that liquidating dividend. Liquidating dividend, which means that the consolidated will pay out its entire book value in dividend and cease to doing business at the end of 2027. Okay. Calculate the value of the consolidated stock using the residual income model. So first of all, you calculate this balance.
Yeah. I've done that.
Yeah,
Closing book value is 7.1.
7.1, right? Okay. Now earning minus equity charge. Equity charge will be here, it will be 6.50
Into
into
14%.
14 percentage. How
It's
much?
0.91.
0.9. And then now earning minus equity charge
0.19.
19. This will be the next year's opening book value. Now you calculate
7.1.
this.
And that is 7.5.
And equity charge here, it will be 7.1 into 14 percentage.
14%. It is 0.994.
Hmm.
So
Now
here the
earning,
answer is 0.06.
and this again will be the opening book value 7.5. And see, you have this much money, you are going to pay everything as dividend and you want to
Yeah.
stop doing business. So add
So
up these two.
8.45.
So 8.45 you are going to pay as dividend. So that closing book value is 0. And equity charge will be 7.5 into 14 percentage.
7.5 into 14%. 1.05.
So earning this minus this is how much? 0.95 minus
Uh,
1.05. So residual income is negative.
yeah. Minus 1. Minus 0.1.
Minus 0.1. We'll just check the numbers. Yeah, minus 0.1. Now that's it. Now I just have to discount it. 1 plus. So the discounting is again with the required rate of return, which is what? 14 percentage. So 14 percentage raised to 1. 1 plus 14 percentage raised to 2. 1 plus 14 percentage raised to 3.
Hmm.
Calculate all this, that becomes the value.
6.64. The total answer. The
Six
total
six
answer.
point six.
4.
I got six, here it is 6.61, then I think it's just decimal problem. 0.19, 0.01. This 0.01, we got 0.06. How?
They have taken only 2 decimals. I've taken 3 decimals.
Okay, 7.11, 0.6, 7.5, 0.994, 0.01, 0.06.
They have taken only 2 decimals. I've taken 3 decimals.
Okay,
Oh,
this is all decimal problem only, no?
yeah.
Then it is fine. Okay.
But that
Yes.
0.01 and 0.06 is a huge difference then.
No,
No?
you have taken, so you just calculate again.
No, no,
1 minus
I
0.
got the problem. They
Huh,
have taken 0.99 and I have taken 0 in equity charge. They
you
have
have
taken
taken,
2 decimals. I have taken 3 decimals.
which is okay. That is all fine.
Okay.
Fine. Okay. That's it, right?
6.64 is the
Yeah,
answer.
here they are getting 6.61, it is, which is okay then. Okay, fine. Then this is another formula. This is for constant growth. Okay, R minus G. The moment you see R minus G, this is for
Huh.
constant growth. So residual income for constant growth companies. Okay, so we'll stop now here. We'll continue from this section tomorrow.
Okay.
Okay,
Okay.
we'll
So
stop now.
tomorrow early morning or 10:30?
Let's just standardize them. Let's keep it as 8:30 to 10:30 for you, so that
Okay,
there is
okay.
no confusion.
Yeah, yeah, yeah,
Monday to
yeah.
Friday, 8:30 to 10:30.
Okay,
Okay.
okay. Yes.
Okay. Okay. Bye. Bye.